Hello and welcome to another episode of the Trusted Trustee podcast. And as usual, I'm joined by Tracey Besters from the Southern Highlands. How are you, Tracey? It's really great to see you as usual.
Thank you so much, Darin. I'm really well, and it's wet and soggy in the Southern Highlands at the moment, so it really does feel like the Highlands.
Oh, well, I'm not in the Highlands. It's wet and soggy here in Sydney as well. So it looks like New South Wales is afflicted with that sort of wet weather at the moment. And of
Yes.
course, this podcast is brought to you by Super Fund Property Valuations. Take the tension out of tax time by making Super Fund Property Valuations your number one choice for all your SMSF property valuation requirements. Order a report today by filling in your details online at superfundpropertyvaluations.com.au and let Superfund Property Valuations take care of the hard work. And Will Spark and the team there doing great work. And of course, I keep banging on about this. Valuations are very important. And if you don't believe me, just ask the ATO because it is an absolutely area of razor focus for them right now and will be in the lead up to Division 296, whenever the hell that comes in.
Yeah.
Anyway, we're not
Hopefully a long
here to.
period of time in front of us, Darin.
No, no, I think it'll be upon us fairly shortly, but some sort of indication of the time frame so that we can perhaps start preparing what we
Mm.
do in the advent of it would be really good, but I don't expect the government to be at all helpful with what we do and what the sector does. So look, your guess is as good as mine as to what will happen with that. Anyway, we're not here to talk about Div 296 because
Yeah.
everybody's talking about that. We've talked about that infinitum, ad infinitum. So it's better that we move on to a different subject. And in fact, it's a bit of a follow-on to the last episode that Tracey and I recorded. We did cryptocurrency last time, and one of the big issues there is the separation of assets or where to hold the crypto or digital asset and which name in particular that it needs to be held in. So we thought we'd delve a little bit further into actual asset separation
Mm.
that trustees must adhere to when it comes to their own personal assets as well as the assets of their super fund. And it's really easy. I say that and it sounds like a really easy concept, but the fact of the matter is that the individual, and as we say all the time, has to wear different hats with what they do with their super fund.
Mm.
It can be confusing about which hat I'm wearing today and in which capacity I'm acting in. And it doesn't take much to just have a slight slip up. And then, of course, you're having to unwind stuff and you might get into compliance trouble. So it is really
Mm.
important. It's not, as I said, an easy discipline to maintain, but absolutely critical. And it's not just us saying it, Tracey, is it? It's actually written into a legal obligation that trustees must undertake, isn't it?
Yeah, absolutely, Darren. And I think that at face value, it does seem like a simple thing, right? You must keep your assets separate. um, that's easy until it actually becomes practical real life stuff, and that's where it tends to go wrong. But you're absolutely right. You know, there is a regulation in the SIS regulations, the superannuation rules, which we are bound by as part of the SMSF space, and that's our Reg 4.09. And in that reg, it talks about the fact that SMSF trustees must keep their super fund assets separate from any other assets that the related parties of that SMSF might have. So whether that is a trustee company or whether that is the members of the fund who are individual trustees, you've got to keep them separate, which seems easy,
Yeah,
until people get involved.
piece of cake. But probably the reason why it's not so easy is theoretically, it's nice to be able to say, oh, Tracey, can we strategize what I should be doing for my SMSF? And we might come up with a strategy whereby, oh, Darin, if you want to include a residential property in your fund, yes, it's suitable for that. So off you go and we'll start the process. But
Yeah.
it can be like a situation that I see a property on the weekend. I haven't got my superannuation checkbook with me, but I want to act on well, if I don't snap it up, somebody else will, and that's perfect for me. And that's when it's like, oh, maybe I can just put down a deposit, and
Mm.
that's when it starts to get a little bit complicated. So it's not as cut and dried as it sounds at face value, because there are life situations where, I had to act quickly. I did it like this. Oh, damn. I'm bound by other
Surely.
obligations, and I wasn't able to adhere to them. What do I do? So it's not
Yes.
as life isn't. It's not just a series of, yeah, this is perfect and we can do it like this. And so people find themselves in this situation, and it's not a knock on them. It's completely understandable from a practical standpoint.
Yeah, absolutely, Darin. And it kind of gets really complicated when you that's a great example that you used about, found a property. Surely Tracy or one of my, my accounting team will fix it up for me. It's not going to be a problem. They'll be able to wave their magic wand and all is good in the world. That's, great example. But it can be even more simple where you just don't get the name of the trustee right. So let's say you and I are in a super fund together, Darin, and you go into the bank to open up a bank account for our super fund, but because you're the one opening up the bank account, you say it's the Darin superannuation fund. It's Darin and trustee for the Darin and Tracey super fund, but I'm a trustee as well. So I should actually be on the name of that bank account as a trustee, just along the same way as you. So it can just be as simple as not having it named right from a trustee perspective, or we have the Darin and Tracey bank account, but we don't say it's actually on behalf of the Darin and Tracey super fund. So at face value, it then looks like, well, that is a personal bank account that you and I might be holding together as partners in a partnership, as opposed to as trustees for the super fund. So it just is really, you have to just be really careful, I think, about how you set these accounts up. And you can't just go and set it up willy-nilly without making sure that you have got the trustee name right, you have got the name of the super fund, it's in trust for the super fund or in the super fund account, whatever the terminology is that that particular provider needs you to have. And of course, it's not the same across all banks. It's not the same across all share registries, and it's not the same across all investment managers. They all have a slightly different take on, should it say superannuation fund? Should it say super? Should it say account? Should it say, X, Y, and Z? So you've really got to check each and every time.
Yeah, that's a great point, Tracy. And I suppose knowing exactly the name that you came up with, but also knowing exactly the details is so important. And I mean, we don't necessarily always do that when we're asked to fill out forms. Sometimes they ask for, your two Christian names or your two given names and your
Yep.
surname. Sometimes they don't, and it can be easy to when I set it up, I use this name. And
Mm,
then somebody else asks for a name in full and you use that name, and then all of a sudden there's an incompatibility there.
yes.
And again, you're finding yourself in a whole world of hurt of trying to explain that away and take whatever rectification action that you need to take on that. And as I
Yes.
said, at the beginning, it's not a knock on the individuals who do this because or find themselves in this predicament, because it's not an easy discipline as an individual to exercise. And in fact, Tracy, there was a case which didn't involve individuals, actually involved professionals,
Yeah.
where a tangled web they wove, and
Yeah.
then it all kind of unraveled, or they got caught in there, and it was very difficult to get out of. So,
Yeah.
there was a legal case, wasn't there, Tracy? Take us through it.
Yeah, that's absolutely right, Darren. And we're going back to 2016, so quite a few years ago now. But this is actually a WA case, and it involves someone that probably should have known better, to be honest. But again, we all tend to sometimes get ourselves in a bit of strife. And what happened in this particular case is the company that acted as an accounting firm was also the same company that was the trustee of a self-managed super fund. And sadly, the accounting firm went into liquidation. And what happened there is that there was a confusion as to, well, if it's in the name of the trustee, this company owns assets, which assets does it own on behalf of itself or on behalf of the super fund in the super fund capacity or super fund trustee capacity. So that was that whole case that, went on for quite some time. There was a bankruptcy. So obviously the trustees in bankruptcy were trying to determine which assets they can deal with and which assets they in fact couldn't deal with because they belonged to the super fund. So absolute nightmare. And I think it's a really good lesson, Darin, for those self-managed super funds who have a company structure, a company trustee, who also act in a different capacity. It's really important that you can have that line in the sand, or it should be a deep, deep, deep crevice to show which assets actually sit on which side of the crevice, and making sure that it's very clear that the super fund trustee has these particular assets for the super fund, not for any other capacity that they might be running, such as a family trust or a trading entity. So yeah, good lesson learned in that case.
You describe it as a crevice. I would actually suggest there should be a canyon in between
The
the
Grand
two.
Canyon of SMSF. There you
Absolutely, so that there is
go.
absolutely no confusion. And I mean, again, professionals, they have to, I mean, in a professional capacity, very often you have to wear different hats at different times anyway. For them
Yes.
to even get it, like they've got that discipline going pretty much on a day-to-day basis in the running of
Yeah.
their organization and the services they provide. But if even they get confused with it, it just really goes to show how difficult a discipline it is to maintain
Yes.
and not fall foul.
Yeah, absolutely. And I think, Darren, it can, so we're talking about, making sure the trustee name is right. And I still am seeing, even, as recent as the, last financial year review of accounts, that I'm seeing still where we've got trustees doing these multiple roles. And I'm just not a fan of trustees doing multiple roles. So number one, I'm not a fan of having individual trustees, because when you need to actually change investments or change anything with an individual trustee because of you've added a member in or a member's left the fund, that's very difficult in itself. And we've actually had that conversation in a prior podcast, that although you've got to set up this company to act as the trustee from the beginning, it's much easier to manage through the life cycle of the SMSF. So that's one thing. But when you actually need to change, so let's say you haven't set up a corporate trustee to start with, you've gone individuals, Darin and Tracey, and then we decide to have the Tyson-Chan / Besters Proprietary Limited company. When we go and do that change, you've got to make sure that you then notify all of the various bodies of investments that you have. And we often see that the auditors are picking up on situations in an SMSF where they haven't changed the name of the trustee properly, and that gives rise to a potential breach of this Reg 409. So you've got to be really careful when you actually do a change of trustee, that you do actually make sure you do all of the steps. It's not just signing the company documents and saying, woohoo, we've got a trustee. We've told the ATO, sure, we must have done everything we needed to. No, you've actually got to go through each of the steps. And most auditors are going to be pragmatic. They're going to ask the question around, well, what do we need to do? But you certainly can't just leave it like that, right? You've got to action it. Otherwise, it's going to end up being a breach.
Yeah, you raise a great point. I know it's not what we're talking about now, but again, it's another great reason to have a corporate trustee because
Yeah.
if you can eliminate down the track of, oh, I should have had a corporate trustee and so I'm going to switch. Well, that's just one administrative procedure that you can avoid. And of
Yes.
course, again, it can trip you up in the names and the final details that are involved. And why not just avoid that straight away from the
Yeah.
start? I mean, you can't avoid it totally if you're obviously changing directors or whatever, but you can avoid that switch, which is a little bit cumbersome and probably unnecessary. If you're willing to pay the extra costs, then I think it's probably a better outcome in the end, of course. Now,
For sure.
all of that comes with a bit of proof of ownership too, doesn't it, Tracey? I mean, that's really important when we're talking about this as well. And no doubt the auditors will be hounding you for proper proof of ownership as to who actually holds the title to the asset.
Yeah, absolutely, Darren. And we, we kind of touched on this a little bit when we talked about collectibles and the personal use assets and, the gold bar that we've got sitting in the backyard. Not that we do have that because, that would be not okay. But
Oh,
how do you prove ownership? And so you've got to have a paper trail and contemporaneous documentation is the buzzword and lawyers love that contemporaneous point because it means that that record was created at the point in time that something happened. So having the ability to be able to show that evidence. Now, sometimes you might find, and this comes down to the audit firm that your SMSF is audited by. Sometimes the auditors might want to see some sort of declaration. So if it's not 100% clear, or they just want the total confirmation from you as the trustee, you sign a declaration to say this asset does belong to the super fund, and this is when I purchased it, or this is why it's held this way, or whatever the specifics are of that case. But having a trustee declaration or an asset declaration is something that is not, untoward for the auditors to ask you to do. And obviously they're relying on you as the trustee to sign that in good faith and to tell them honestly that that is the case. So don't sign a trustee declaration that's not true, because you're just
yeah.
going to dig yourself a massive hole and cause an issue for everybody. So, but yeah, that's one thing that auditors might rely upon.
Yeah, well, that's obviously very important because I know that the ATO definitely frowns on not taking trustee declarations seriously. And
Yes.
that is certainly one area that could really come back to bite you because there's no excuse for it. It's not like you can come up with any credible excuse to get out of that obligation because whatever
Yeah.
you think might be a justifiable reason it's not going to fly. That's
Yeah.
absolutely the case. Now we're
Yeah.
going to move on to some war stories and some sort of practical um, sort of
Mm.
situations where we've seen this, and I can actually start, Tracy.
Okay.
Because there was a confession. There was a confession by an SMSF professional. I won't name him by name that during a webinar he actually said it wasn't about this, but it was more about how you rectify errors. But he confessed that at one point in time he actually accidentally paid a bill on behalf of the super fund out of his own bank account because I think they were at the same bank, and he just
Yeah.
inadvertently selected the wrong one and then the money went out. Now, luckily for him, he found out almost immediately and thought, oh,
Yeah.
I've done something wrong. And in that situation, he was able to rectify it because he immediately, like literally immediately said, I made a mistake, blah, blah, blah.
Whoops. Yeah.
But I mean, he's a professional, he's an SMSF professional. And
Yeah.
even he, and again, in his case, I'm sure it would have only been a momentary lapse in concentration. Maybe he needed
Yeah.
to do something quickly. And sometimes these, again, like the auction, like the property option, you need to act quickly on something. And that's when it's
Yeah.
like, oh, bang, 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 bang. Oh, I didn't,
Whoops.
yeah, I didn't do this properly.
Wrong
So
bank account. Wrong credit
easy to
card.
do. So he drew money from the wrong bank account, which is
Yeah.
so easy to do. But as I said, he's a professional of the industry, and even he got it wrong in that
Yes.
situation. Yes, he realized, which is fantastic,
Yeah.
but easy slip up to make.
Yeah, absolutely, Darren. And we do so much on our phones these days, right? And sometimes it's, you're scrolling through bank accounts if you've got multiple different bank accounts linked to your internet banking. It's not surprising that it's accidentally click on the one bank account. And even more so if the bank accounts are not labeled well enough on your internet banking to know which one's the SMSF. It almost needs to have a do not touch label on the bank account to do that, right? So, but if it's an SMSF expense, you've paid for it personally, or you've paid for it from outside of the super fund, then yes, you do need to reimburse yourself. If you want to reimburse yourself, you must do that as quickly as possible. And if you don't reimburse yourself, then it's going to be deemed to be a contribution, which, most times will be okay if you have concessional cap space or non-concessional cap space. But if you are at your limits and you can't make any further contributions, either because of age or because of total super balance limits, then you could actually cause this, whole cascading effect by paying something on behalf of the fund and not getting reimbursed immediately for that. So that is a good introduction to some of our war story questions or discussion, I guess. And, there's lots of questions I've had over the years around, well, can't I just, pay for it on my personal credit card and get the points and then reimburse myself after a month? And probably doesn't cut it, Darin. It's probably not quick enough in terms of reimbursing yourself, because you knew that you incurred that expense. You knew that you incurred that expense outside of the superannuation fund. And remember, yes, you do have a member hat and a trustee hat, but most people that work in two hats still know what the left hand and the right hand are doing.
Well, should do.
Should do, right? Should do. So you have to, if you're going to reimburse, it has to be as soon as possible. And 30 days or 55 days, if you've got an interest-free period on a credit card, probably doesn't cut that.
Well, the other word of warning there, if you're ever looking to think that, oh yeah, I could probably do that, don't forget the ATO aren't a bunch of mugs,
No.
right? You can't just give them any excuse. If you say, oh, I just made a mistake and I paid it accidentally out of the wrong bank account. I mean, they will ensure that what you did was a genuine error. So they will probably have a look at the bank balances of both bank accounts and
Mhm.
maybe consider that, like if it was the other way around, you paid for a personal expense out of your super fund and say
Yeah.
it was for, I don't know, $5,000, and they have a look at your bank account around that time of when the transaction went ahead, and you only had $100 in your personal bank account. Well, I think they're going to be a little bit wise to what's going on here.
Yeah.
They wouldn't just, I mean, they're smarter than just accepting any excuse that, oh no, Tracy, was a genuine error. How come you only had $50 in your bank account? Oh, really? I didn't even
Yeah.
know that. Sorry. So yeah,
Didn't have visibility to my personal bank account at the time. No idea what you're
no,
talking about.
so
Yeah.
so you've
Doesn't,
got to take these things seriously, obviously, because
yeah.
it is serious. I mean, it's as we mentioned at the start, it's written in legislation and
Yeah.
regulation, and what could be more serious than that? That's actually a regulation breach. So,
Yes.
no one wants to go down that path. But that's just
Yeah.
one. To tie it
Yeah.
back to the last one, crypto's again a great example of this, isn't it?
Yeah. Yeah, absolutely, Darin. And crypto, I think, is where I've seen some issues around separation of assets, particularly when we talk about that cold wallet versus the hot wallet. And
Yes.
if you didn't listen to our last podcast on crypto, then go back and have a listen for that explanation about the difference. But if you've got something in a cold wallet, then how do you prove that it actually is part of the super fund assets and not your own, if you also hold your own digital assets personally as well? So being really careful about the documentation and the paper trail for that. So, and just to I just thought about this too, Darin, just to go back to the last point about paying for an expense on behalf of the super fund. There are things these days where you have to pay by credit card or you have to pay by debit card of some sort. And not everyone does have like a card facility against their SMSF bank account for obvious reasons. You probably shouldn't in some respects. But if you've got to pay for something online via a credit card or a debit card, you can legitimately reimburse yourself straight away. That is okay. And that's not going to fall foul of keeping assets separate, because you have done the right thing and you have actually reimbursed yourself. So I don't think that we're saying that you can't pay for something online if you don't have the ability to do that. That's not the case, but you do have to reimburse yourself straight away. So anyway, that just came to my mind.
Yeah, no, the timeliness of the transaction or the reimbursement transaction is so critical to this, because obviously the more rapid it is, then
Mhm.
the more likelihood it is it's a genuine thing, and it's almost like you've completed the transaction by the reimbursement rather than just
Yeah.
taking one step towards it and then just letting the rest of it sort of fester and then But and it's not in your interest to let it ride because we all know that if it's not top of mind,
Yeah.
revisiting in a month, 2, 3 months time,
Yeah.
we all go through the process of, oh, what did I do again? Trace, can you remind me of what happened there again? I can't. Yeah, I know I bought this thing, but sorry, what happened? Oh, that's right. They didn't take they didn't take a cash payment, so I had to pay. But like, what do I do now? Sort of
Yeah.
thing. Like
Yeah.
the longer you leave it, the worse. Even if it's legitimate, the worse it's going to be because it's not fresh in your mind, you know. And if it's
No.
not fresh in your mind, that can create other things because what if you inaccurately think that you did it like this and it's like, oh, that's not actually what happened. Oh, I
Yeah.
remember now. Yeah, that's right. I had to do that. Oh, but I fixed it as if it was like this. So
Yeah.
have to fix it again or look at it again.
Yeah.
Doesn't
Or
matter.
like I said before, Darren, if you don't reimburse and then it gets to the end of the financial year, you're looking at your year-end planning and you go, oh dear, I forgot I paid this expense way back, in August or September, and I haven't reimbursed myself. Well, it's probably going to be a bit late by then because, you're now kind of, in June
Yeah.
the following year. So it could therefore be a contribution, as I said, deemed contribution. It's increased the value of the fund. So deemed contribution, and basically then you're going to be stuck with those contribution caps. And if you've then made a non-concessional contribution, you've gone over your caps, and we've got to deal with all of that. So something that could be quite small becomes actually quite large. So just be careful. Just be careful. But I've got another little story, Darren. I've got another little
Oh,
story.
great.
So
I
here's
love
one.
these.
So, it happened quite some time ago, but it was a situation where trustees, individual trustees, could actually get a higher interest rate if they put the money in their personal savings account, like special bonus saver, goal saver account, than they could get in the SMSF. So they did that. They thought, well, that's not a bad thing. We can get more interest on behalf of the super fund if we do it personally, as opposed to setting up an SMSF account with that particular bank. So they did that. They took the money out, decent amount of money out, put it into their personal account, and then transferred it back with the interest a few months later. And that obviously became a little bit of a question and answer with the auditor at the time.
Well, there's no surprise there because if you've got an existing balance in your personal bank account and then you transfer superannuation monies in there, even the best accountant I would say would struggle to delineate what the additional balance was on top of that after that transfer was made. And then if the whole pool is earning interest, and of course it
Yeah,
is,
yeah.
then how do you allocate the actual earnings to what is personal and what is for the super fund? I mean, you can probably do it. I'm not saying you can't do it, but what a mess.
Yeah, and that's the thing, it is a
Would be
mess.
my reaction.
Yeah. And to the credit of the trustees, they weren't trying to rip money out of the super fund. They were
No.
actually trying to earn more money for the super fund because they were getting a higher return for cash at bank than the super fund was able to get from an offering from the bank. So, that's an example where, like you said before, it's no judgment on the trustee of the fund. They think they're doing the right thing by, generating a higher return, but they just didn't understand the administration and compliance issues that go along with that. So yeah, so that was a bit of a interesting one. And sometimes you have to hold the asset in your own name though, right? So some jurisdictions, particularly if you have overseas assets that the super fund has invested in, property, for example, overseas, sometimes the overseas jurisdiction doesn't recognize a self-managed super fund structure because that's unique to us in Australia. So
Yes.
sometimes you actually can't hold the asset or show on paper that the asset is held in this very regimented trustee company as trustee for the super fund. You actually have to work within that jurisdiction, and that's where your contemporaneous documentation, minutes, resolutions of meetings by the trustees, some sort of other confirmation that that asset is actually for the super fund, it was paid for by the super fund, all of the income and expenses are going back into the super fund, that all becomes really important because you just can't show the particular paperwork from an overseas jurisdiction.
And I suppose situations like that is needing the ability to recognize that they are constraints that you're going to have to face if you do
Yeah,
want to hold the property from overseas. And then,
yeah,
of course, figure out what how you're going to deal with that, how you're going to manage that right at the start, because you know you're
yeah.
going to face it. Don't just let it, oh yeah, we did that. Oh no, what are we going to have to do now?
Whoops.
Always, even though it's not really prevention, but in effect, prevention is better than the cure, always.
Yes, absolutely. The other thing that the auditors will want to see too, Darin, and this comes up, fairly regularly, is that they want to, so even expenses for the super fund, if you have, a family trust and a super fund and a company and your own stuff, and let's say that you get, let's say you've got property in your super fund and you get a tradie along to do some work, make sure the invoice for the expense is in the name of the super fund and not in some other random name, because that will become a question either from the administrator/accountant or the auditor, because they want to make sure that you're not actually paying for an expense from the super fund, out of the super fund on behalf of some other entity. So just be mindful about that sort of stuff. Sometimes tradies don't put the address of the property on their invoice, or they don't, it might have a colloquial name or some other common name for the property. They don't actually put all of that detail on the invoice themselves. So that can become a potential issue. So another little takeaway there.
Yeah, that again highlights what a challenge this is. You have to look out for other people's administration as well to
Yeah.
establish your own audit trail to ensure that no, it's on the up and up. I'm not
Yes.
doing anything untoward here, but I mean, of course, that can be difficult. I'm not singling out tradies, but usually their billing process is not something that they spend hours poring over. Often it's just done really quickly after the job is completed. So, and
Yeah.
it's not their fault. I mean, that's just the way they operate. But again, it's up to you as the trustee to ensure that all the paperwork, all of the I's have been dotted and all the T's have been crossed, as pedantic as that might be. And
Yeah.
that service provider might think you're an absolute pain in the bum for going back to them and ensuring that, oh, can you just make sure that can you just give this to me again to make sure it's in the right name? You have to do
Yes.
it. You're obliged to do it. They're not the ones on the hook. If there is anything untoward, it'll be you. And then the question will be,
Absolutely.
well, Darin, why didn't you ensure that the proper name was on the invoice? You should have done that.
Yeah.
Okay. Well, I know
And you'll
now.
get a reminder most likely from your accountant that that should be the case. And to be fair to service providers, they don't know what name we own a
No,
particular asset. If
no.
it's a physical asset, do they? Like if it's a property, we don't necessarily go around telling everyone this is my self-managed super fund property. So make sure you do the right thing by me. So it's up to us. It's up to the trustees. And remember that as a trustee, when you become a trustee of a super fund, you become a member of a super fund, you actually sign that declaration with the ATO, trustee declaration form. And on that particular form, you do acknowledge about keeping your assets separate. So just make sure we do it. And if you genuinely attempt to do all of the right things, then you won't fall foul of this particular piece of legislation.
Yeah, just remember, as a trustee, it's all on you. As unfair as that may be in certain circumstances, it is all on you, and that is how
Yes.
the APO sees it. So there's no arguing. You're not going to win that argument. Even if they're sympathetic towards you, you won't win that
Yeah.
argument. It is all on
Yeah.
you. So just remember that. Take it seriously. Take the obligation seriously. Hopefully, you won't fall foul of the rules. Well,
Yeah,
I
and
think
if something happens, Darin, and a trustee makes a mistake, they pay for it out of the wrong bank account, just contact your accountant like straight away, ask them what to do. They'll point you in the right direction. Don't leave it until you hand your accountant all of the stuff at the end of financial year,
no,
because it might be too late to reimburse yourself at that point, and you might be stuck with the fact of it being a contribution when you didn't want that. So make sure to be open the communication lines with your advisors and accountants so that you can reimburse that kind of expense straight away, or you can pop the money back in your bank account if it's gone the other way around and the super fund actually now owes you or whatever it is. So just communicate and Make sure you're on top of it though. Don't ignore it. Keep on top of it
No,
and do your best to keep the assets separate.
yeah, absolutely. Well, I think that pretty much wraps it up for today, Trace.
It does.
So again, I'd love to thank you for your contribution from the Southern Highlands.
Thank you. It's been fun this afternoon, and I actually look forward to seeing you in person real soon, Darin. We're actually going to see each other
Yes,
face to
yes,
face, which is
we
exciting.
will be doing that. We will be doing that very, very shortly, which is fantastic. We love to connect with all of our SMSF connections in the industry. Thank you also to my production team for putting this together and also uploading it on all of the channels in which you can access this podcast. Thank you again to Superfund Property Valuations for their continued support of these podcasts. But most importantly, thank you to you for listening and for joining us or viewing, whichever platform you might be watching or listening to this podcast on. And if it's on YouTube, don't forget to smash that like button and subscribe to the channel. Other than that, that's the end of this episode of the Trusted Trustee podcast. We hope you've enjoyed it, and we look forward to you joining us again the next time we put together an episode. So until then, see you later.
Bye for now.